I love people. So this is the financials for Wisynco. This is really just an overview of what we are in the last video. Plus, me kind of want to show off my little mic because we picks it by me mic. So yeah, there is that. Anyway, so essentially, Wisynco at the beginning normally sold shoes, better shoes, etc., etc., and other haberdashery stuff, which essentially is just things that men predominantly would use. All right. And as time progressed, they ventured into the fishery industry. However, after a while, they transitioned from that and then started distributing beverages and other grocery products. Now, Wisynco makes their money in two main ways. You have one, which is manufacturing, and two is distributing. And the products that they distribute themselves are water, can water, bigger, and boom. Personally, shout out to boom because honestly, it has kept me awake back when in college. So there is that. And then the products that they distribute per se, then they distribute their own products. But in addition to that, they distribute products for their three main partners. One is Coca-Cola, two is Worthy Park Estate, and three, which is Trade Wind Citrus Limited. They own 50% of that company. But yeah, so they distribute those. And some of the products that they have distributed are, I'm just going to put it on screen so you can see it. Additionally, some noteworthy stuff. They have recently, well, not recently, but they have partnered with Devon House to distribute ice creams into like supermarkets and different retail outlet areas so that people don't necessarily have to go to Devon House to get Devon House ice cream. So there is that. And additionally, Wisynco owns all the franchises for Domino Pizza, Wendy, and Hazen ice cream. I don't know why I can't pronounce that, but all those franchises in Jamaica. So there is that. Now we're going to jump to the financials. We'll talk about all the lovelies. So yeah. All right, love people. So this is the financials for Wisynco. Right off the bat, I'm going to say this is a very stable company. But let's jump in the financial. Of course, what we're going to be looking at, we're going to look through the financials. We're going to, of course, do relative valuation, dividend, acquisitions, and our regular. So do quant analysis. There's something else that I've done per se, that might solidify my theory, but just stick around. We'll just continue. So off the bat, I want to see these revenues are not, for example, this is not actually 54 million, it's actually 54 billion dollars, as these, like, just to make the number them smaller, just take off the zeros then, but 54 billion. And Wisynco is one of those companies, so you can expect Wisynco, Grace Separad, probably Jamaica Broilers, more or less. Their their revenue may be large. However, when it comes down to their net profit, it's going to be small in comparison to what the revenue is. But in the grand scheme of things, a company is not seeing $5 billion in net profit, basically. So that's just a pointer. But anyways, we'll continue. You can also see that the earnings per share, I don't remember of them coming to the market since the time them come on the market. So I don't see any dilution in the shares. However, as you can see, the earnings per share each year has continuously increased. All right, means say each share is technically value more, even though the stock price not really up show it per se. But yeah, no continue. So there's a few stuff through the financials that I've highlighted. Yeah, there's a few stuff through the financial I've highlighted, like this per se, the 15 million, like this big jump from property, but as you all know that they were in the acquisition phase of expanding them factories and buying new equipment, etc., etc. So that was like one of the main reasons why it moved from 14 to 15, which is good. And yeah, it shows. It shows. So honestly, them total assets increased to 36 bill. Um, but yeah, so total assets, and also a company this big, I wasn't expecting this drastic difference in them liability. And that's why I'm saying them stable. I'm going to show you something per se. I'm going to show you. Alright, so current liabilities, basically, as you can see, you can see the difference in them assets compared to them liability. Alright, but I want to show you something. This is the retained earnings, meaning so them almost have cash reserves, but basically they basically have cash reserves right here. So that is half of what the revenue is this year, basically almost half, right? So them have $22 billion in like just cash reserves sitting down just in case a worst case scenario. And it shows when you look at their ratios, it shows that them good, them govern. Alright, so what we're going to do is jump to the ratios, just quick overview. Our made videos on explaining the ratios, so I don't necessarily think I need to, but basically you want something at least one, like one current ratio just means say if in the event that they are in a crunch, how fast them can sell what they have as current assets. But yeah, so basically it just say if a company in a crunch, how fast them can sell off them current assets, meaning assets that should be used up within a year. So yeah, and so far they have, and even though they have gotten bigger, they've still maintained over one. Quick ratio is equivalent, is essentially the same as current ratio. The only thing is that you're taking out inventory, assuming say your inventory might can't sell off at that point, and you're still over one. So that is good. Now here, so which is efficiency ratio. Predominantly, Wisynco does manufacturing, but they mostly do distribution, meaning other products them sell or them distribute on behalf of the customers. Alright. So the inventory turnover ratio essentially just means how fast they're getting the inventory out, and yeah, how fast they're getting them inventory out and getting new stock. And in 2019 they're at 3.5 times for the year. Yeah. And up to 2024 it's 7.64 times. I mean that they're essentially distributing are selling more. The number of days which inventory is tied up mean essentially how long them inventory just day in a limbo has significantly decreased, which is good. Meaning that it normally take them 100 days to sell off everything. No, it take them less and less all the way to 50 days. Average collection period just means after them send out them goods, because most of these stuff more than likely going to be on credit. Alright, they're going to have a credit line for each of the company distribute to, and as such, the credit line going means you're giving people them the giving the other companies them the goods and then hoping they pay. So in 2019 it took 4.49 days, essentially like a little over a month, to know where it's 24.53, which is little under a month. So it's getting better. And honestly, I needed the account receivable turnover in order for calculate the average collection period. So yeah, and as you can see, it increasing means them a better collection agency, even though they're technically increasing the amount that they are sending out. So yeah. And then these are just like profitability ratios. Uh to be honest, as I was explaining earlier, you can margin, so gross profit margin would mean say what directly affects the sale, what directly affects the company to make said sale, and what is the percentage them keep for themselves. So if them sell some for $10, $3 essentially would be their gross profit, and then net profit now mean every other stuff that have come out a little change what they make in order to reach net profit for say, oh, this is what we have bottom line, which is a shy of basically 10%. This is 9.6%. So it's always in like that region, but them gross profit margin are normally around the 30 some percent mark. So there is that. And then you have leverage, meaning structure structure ratio is really debt to equity at the end of the day. As long as it's not one to one or more than one, it means that you govern. Or at least the company is okay. Means your equity can cover whatever they them have as it stands. And coverage ratio just means how well them can cover them interest payments. And as you can see, I don't know, this 121, them they are fire. However, I feel like the reason why them coverage ratio probably gone down so much is because of them big spending that they made to increase them assets. So I think they should still be fine. They'll be fine regardless. Alright, so now that I have that out of the way, we are going to look at the DuPont analysis to figure out what are the drivers that like make the company make money. And as you can see, there's no big jump really. Them continuously grow, but at the same time, the whomsoever them have on them accounting department is doing a very good job because they've been able to maintain it. As you can see, the return on equity has been roughly the same, and even though they've continuously increased, as you can see with them revenue, the revenue been a grow more, and them assets been a grow more, them still able to actually maintain them still actually able to maintain that 20% or above. We see what happen next year because they're very close to the 20%. See what happen next year. But see the graph here, essentially there is not much movement. It's flat line, and that is also probably one of the reasons why I don't think the stock price is going to really move. Or even if it moves very, very slow. But I'll show you when we go to dividends because we did go through like literally sit down and find the date and the dividend pay and the stock price, etc. etc. And then last thing, as relates to the financial per se, is the Almond Z score. Essentially, this really just measures whether or not a company is about to go bankrupt or not. And uh, you can like calculate this. This is the 5-step Almond Z score. I didn't do the 6-step because I don't think Jamaica companies really need the 6-step. But 5-step Almond Z score. Yeah, 5-step Almond Z score. And I know you most people may not know what this means, but essentially what it does is just basically stress test the balance sheet. Essentially. Alright, stress test the balance sheet to see how now you best stress test the balance sheet and the cash flow statement to essentially see if a company have what it takes to weather, let's say, a bad start. And normally you need an Almond Z score of 3 and above to be classified as super safe. And as you can see in 2024, so you can 2019, 20, 21, 22, 23, 24, you can see they're at 7. So the benchmark is 3, but they're at 7. So yeah, And this is a calculation. Yeah, there's different values each of them here carry. So it's a weighted calculation. Anyways, so yeah, so they are pretty safe. Pretty safe. Alright, so now relative valuation, get this out of the way. So this is the relative valuation. As you can see, these are the companies that are in it. As I did tell member the big three. You have Wisynco, Sepra, Jamaica Brothers. Why Grace is not in it? Because Grace is a conglomerate. Yeah, them have them on not much things. So you can't really put it here. So this is a weighted average, by the way. So if you add it up, not gonna necessarily be the same thing, but it's a weighted average based on them market share. But so in the grand scheme of things, when I did check the stock price, it was at $21, I guess. So as we said, relative valuation is just comparing how the market is performing. It's currently a little overpriced, but I don't relative valuation not going to be what going to be the determining factor for it. This is relatively, as I say, a very stable company, so this may not even carry much weight as relates to them because some of these companies may be inflated. But yeah, anyways, next to the dividend. The dividend now, as I was saying, if you check, this is from 2020. It's from 2020 to 2021, 2024, and I just sat down and checked all the dividend payouts and the stock price of such. So in 2020, the stock price was 22.86, and then the payout is essential. As you can see, they've been bouncing around the 20 mark for the longest a while now. However, what has been consistent, as you can see, is that the dividend payout normally gradually increases. So if I expect some probably like a 2.3% payout this year, well next year, because them paid them last one already, which was in August. So yeah, so the dividend is a dividend stock, but as I say, because of the nature of said company, it not gonna pay up much. Like not pay up much. It just gonna ensure so that it have everything cover its financial in the event of a hard time, but you'll still give shareholders a little, payout. Like a thank you for being a shareholder. While I see you keep your money safe. So essentially that is it for dividends. No grand, but safe stock. So you can have what them say cake and eat it too. So safe stock pay dividend, it going maintain that same $20 each price range. So yeah. But as a with latest acquisition, it owns 50% of um United United East Limited trade in citrus fruit. And they're currently in a little pinch right now. I don't know the full details of it. Same can find a clip. I did see some on the news. Essentially, them having some issues as some pollution issues, and I think they're either going to be fined or something along that line. To be honest, I don't think this can really affect Wisynco to that, honestly. But yeah, and they've even offered to remedy the situation, so I'm not sure what is the reason why it's still an issue, but they're going to figure it out. So I don't say I don't think they're faking, but I think we're thinking about it was just to put it out there. The other thing is, while I was on TikTok, I saw because I didn't see this on them page actually. The what the company name? One of them partners this Worthy Park. Worthy Park actually has like a tour. So you can actually go there and do like actual tour of the estate and so on, so on, so on. So yeah, which is very good. Very, very, very good. And yeah, they have store you can go there, try champagne, etc. etc. So not champagne but try alcohol and whatever. But yeah, so that was it for the financials of lovely Wisynco. Yeah, probably sharp, but not much crazy to say. Yeah, them have a ridiculous amount of cash reserve. But in the grand scheme of things, the metrics that are driving them is everything. They just keep everything under wraps, them keep them liabilities low, and continue to make a bag of money while paying us a very small dividend. But price to pay for being a quote unquote safe dividend stock. Goodbye stills, but I'm saying not financial advice. It's just that if you are looking for some safe, then you can like check your financial advisor and ask them what they think about this. But um yeah. So with that said. Of course, thank you guys for watching. Don't forget to like, share, comment, subscribe, to a friend. And yeah. Peace. Catch you in the next video.